Okay, good morning, everyone. Our subject today is compensation. And compensation is a very important subject because it is a very important, on the one hand, it's a very important cost component for the company. So it's part of cost management. And so it's important for the company. It's very important for the employees who are compensated. And as we said, the employees, in terms of the human resources of the company, are the most important resource most companies have. So from both sides of the issue, it is an important subject. So let's deal first of all with the major objectives of compensation. Well, one objective is very basic, has to do with why we are compensated for our work services. So when we are in role of being employees, the basic question can be asked, why do we work? Why are we motivated to work? Now, the classical economic answer to that was simple. Actually, for most of us, if not all of us, work is a disutility. It's something we don't want to do. What we really want to do, so goes the classic economic theory, we want to consume leisure. Actually, if it were up to us, most of us would like to consume 24 hours of leisure a day. And it may have been possible to do it. I think, according to the biblical story, it was possible to do it in the Garden of Eden for Adam and Eve because everything was available on the top of the trees and elsewhere. So they can just spend their time walking and playing. But then there was the original sin. And the idea is that goods and services are scarce. So we have to learn how to acquire them. It's also the reason of this program. Without the original sin, none of us would be here. But in any case, the idea is that we have to give up hours of leisure, and giving up hours of leisure is work. So if we decide to work 8 or 10 hours, we give 8 or 10 hours, give up 8 or 10 hours of leisure, and we do so to acquire so that we can be compensated, get income to acquire goods and services. Because we need and we want goods and services. We have to eat. We have to have housing, clothing, pay the mortgage or the rent, and we have other needs and wants which we want to satisfy. So the idea was that the decision to work, how many hours we work and how many hours we have for leisure, to the extent that it's up to us, is the decision because between how many goods and services we want to have and how much leisure we want to have. Now, of course, this view is simplified because a good number of us would say, well, actually, we don't want 24 hours of leisure. We think it's a good idea, bad idea. We don't know what we're going to do with 24 hours of leisure. A good number of us will say, we like to work, or at least we like certain types of work. So obviously there's more to that, but goods and services, the ability to buy goods and services is a basic important objective of compensation. In addition to that, from the point of view of the employer, of the institution or the company, as we said, the institution or the company or the business enterprise is very interested in recruiting, retaining, and advancing high-quality employees, because the quality of the employees, their motivation, their loyalty, their training will affect very strongly the performance of the company. And also very importantly, the owners of the company want to provide the right incentives for the employees to put a high quality of effort on their behalf so as to get the best performance possible. And as we said when we discussed agency theory, the owners of the company cannot directly observe the quality of the effort of the employees. So their best alternative approach to try to secure a high quality effort is to give the people that work for them the proper incentives to achieve this effort by pursuing their own personal goals to also further the objectives and the goals of the company. So those are some of the major objectives of compensation. Now the task is, how do business enterprises and other institutions design the right compensation system to achieve those objectives? After all, they have to deal, most enterprises have to deal with a very large workforce, very diversified, highly professional, very diversified in skills, and performing diversified tasks that need very important coordination. So how do you achieve all those objectives in this context? And that's not easy, as we'll see when we go through the components of the system. But before we do that, we need to acknowledge the distinction between monetary and non-monetary rewards. Monetary rewards are rewards that have direct monetary value in terms of value of cash equivalent. Non-monetary rewards are rewards that are qualitative, that have to do with employment, that are qualitative. They're not directly translatable to dollar values, but they're very important nonetheless. So among non-monetary rewards, we can summarize them in a title like the quality of working conditions, the quality of the working conditions in the enterprises that people work. So they will include human relations between employees at same levels, between supervisors and subordinates, and between and within groups of employees. So human relations, high quality of human relations is very important. Other working conditions in terms of work environment. And most importantly, for non-monetary rewards is the type of work that people do, the quality of the assignments, the challenge, the interest, and the challenge that the tasks convey, the opportunities to learn, to achieve, to contribute, and to advance. All those are extremely important. We are going to acknowledge their importance. We're not going to deal with them in this course because that's not a course in management or in human relationship or in human resource management. So we're going to say they're very important, but we're going to concentrate on the monetary part, on the monetary compensations, which are, of course, very important as well. So let's go over the common forms of compensation, monetary compensation, and the various features. First, the most basic one is salary or wage, and they're the level of the salary. So we need to establish, in designing compensation systems, we need to establish appropriate levels of salary, and or wages for compensation. And those, first of all, need to be competitive. That is, because remember, the skills that we need in a particular enterprise are also skills that are needed by other enterprises who compete for those human resources. So we have set, if we want to retain high quality human resources, recruit and retain, we have to have level of compensations that are appropriate, that are commensurate with the skills, and that are fair, and are perceived to be fair. So those are some of the requirements. Then we have to plan for how we change and adjust those salary and or wage levels in terms of raises. Two important components of raises are, first, the cost of living, to adjust for changes in the cost of living. Usually the cost of living, unless we have deflation, if we have inflation, the cost of living goes up, which means the purchasing power, if you leave the wage or the salary at the same level, the purchasing power, the capacity of salary to purchase goods and services, the purchasing power will decline. So if you want to keep the purchasing power intact, because purchasing power is what is important for the recipients of the wages or the salaries, you have to plan to adjust for the cost of living. Beyond that, you want to increase the purchasing power for those who are meritorious, who put good performance. And so you want to have merit, you want to plan merit increases. And then, of course, you want to train and advance people, give them the opportunity to advance through promotions to higher levels and higher and more demanding and more important and diversified tasks. And promotions are obviously associated with salary or wage increases because you want to keep the wages or the salaries commensurate with the type of work and the type of responsibility that you confer on people. And you want to plan for your talented people rewarding career paths so that they can contribute more and more to the organization and stay with you and fulfill their own goals and be satisfied and pleased with the type of work they do and the type of advancement they have. So all of those and many more features have to be encompassed in salary and wage management and career advancement and career path management. In addition to salaries or wages, we have the fringes, fringe benefits which are abbreviated as fringes. Fringes sound something that is marginal, but the fringe benefits can be significant, very significant. And you look at some of the examples here in the parenthesis, and you can see how significant they may be. One very significant is health benefits. Health benefits in this country are mainly provided by employers. So it's a very important benefit. We are unique in this case because in most other advanced countries, advanced countries, the health benefits are not provided by employers. They are provided in large part by government. So historically, we developed in a different way, which poses problems for healthcare costs and the healthcare system. But nevertheless, that's the way things are. So health benefits are very important. Most employers, particularly big employers, pay a large portion of the health insurance for their employees. And that's a very significant benefit because if employees have to go out there, don't have these benefits, and have to go out there and buy private insurance, private health insurance, this is much more costly. So if you take the difference between the cost of between the hypothetical cost of a private health insurance for employees and the insurance they get through the company, including the portion that the company pays for the group insurance premiums rather than individual insurance premiums, you get, in many cases, very significant benefits. So these are health benefits. Other very important benefits are retirement benefits. Again, people have to provide for incomes in the post-retirement period. And with the increase in life expectancy, the dramatic increase in life expectancy, the post-retirement period becomes longer and longer. So people live into their 80s and 90s. There's a long post-retirement period for which sufficient income has to be provided. Obviously, nobody can rely just on Social Security. So the other income has to be provided through retirement benefits and individual savings. So retirement benefits, whether they are defined contribution or defined benefit types, are very important. Less important but still significant are vacations, number of paid vacations day. People need to take vacations to be effective at work. How many days, paid vacations days, are provided by the employer, sick days, and so forth. Then, of course, we have severance pay. What kind of pay, if any, employees get when they're laid off? Now here, there's a big disparity. If you're at high levels, high employment levels, and if you're desired by companies at top management levels, many of those top managements can use the bargaining power if companies need them and compete for them, and design a contract or put in the contract, in an employment contract, very generous provisions for how much they're paid if they're asked to leave, if they're laid off. So if they're laid off, they're just not kicked out of the 20th floor in a free fall, so to speak, but they parachute, and they don't parachute in simple parachutes, but they parachute in golden parachutes. So when they get down to the ground, they have a golden parachute with them. That's the image. But the idea is, of course, very generous severance pay. Now, those who are not in this position usually in the U.S. get very minimal severance payments, depending on the company, but usually not more than several weeks. If they're vested in, if they have enough time where they're vested in their pensions, they can have whatever they saved in pension portable, but in terms of severance pay, of compensation for being laid off, it could be very small. There are many countries where they have national legislation for severance pay, so it's somewhat, more than somewhat, more significant. Usually, in many countries, they have laws that say that for each year that a person works, she or he are entitled to 1 month severance pay, 1 month of their last salary in terms of severance pay. So on the high side, if you worked for 15 years for a company or you're laid off, you are entitled by law. It's not a matter of negotiation. It's legally provided. The company has to pay you 15 months worth of salary in terms of severance pay. So that's another compensation or benefit. And then, of course, there are perquisites. This is compensation that is paid in kind rather than in dollars. It's valuable, but it's paid in kind. So, for example, if you're given a company car to use, or you're given a company resort to use for a vacation, or you're allowed to use under certain circumstances the corporate jets, or you have a corner office with a great, spacious, with a great view, with marble credenzas and Persian carpets or what have you. These are all perquisites or perks. They have value, their compensation, but they're compensation in kind rather than compensation in money. Now, so in addition, we have all those compensations that are output contingent or value contingent, which means they're contingent on some kind of output or on increase in the value of usually the shares, the market value of the shares of the company. So if we look at output contingent, there are various types of bonuses that can be given that are contingent on outcome. Now, the most prevalent bonuses are contingent on profits. So the outcome that they're contingent on are profits. And the profits can be the profits of the company as a whole, or the profits of the profit center that the employee works for, or some combination of both, where the bonus is usually some predetermined percentage of profits, of the level of profits, or of the extent to which profits beat a certain target. So there are various types. And of course, bonuses don't have to be bonuses necessarily that are based on profits. The outcome, for example, can be dollar sales. For marketing people and sales people, very often there's an additional compensation in terms of commissions. Commissions are usually percentages of compensation that they are paid relative to the value of what they sold, value of the sales that they generated. And of course, bonuses can be based, say, on costs. If it's important for the company to incentivize a good number of employees to save on costs, they may promise bonuses that are a percentage of how much costs has been saved over a certain period, or by how much you beat a certain cost target in terms of cost savings. So all these are bonuses, and bonuses, by being outcome contingent, are designed to provide strong incentives for employees to put extra quality of effort on behalf of the company. Remember, we're to overcome the possibility that being that effort is not fully observable, employees may be, being human, may be tempted to shirk an effort. So that's to give them incentive to put more effort. So bonuses are one possibility. But bonuses are outcome contingent, usually contingent on profits, earnings, revenues, costs. Then you have those who are value contingent, which you have equity, which is contingent on the value of the ownership. So a group of employees can get part of their compensation by being given as part of their compensation shares of the company. So they get shares in the ownership. And the idea is to provide stronger incentives for them to put an effort to increase the value of ownership or the value of the shares of the company. So they're given shares. This type of equity, compensation through equity, which is often restricted, that means it's you, in order to, if you get shares, you have to hold them for sometimes a long period of time until you can sell them and get the extra value. So they're often restricted in terms of the time you have to hold them until you can materialize their value. But equity type of compensation is frequent in startups. Because remember, startups, when they start, are usually small. They're small enterprises. But given that they're startups, that they want to grow fast, and they're new, and very often in new areas, they need very talented human resources to succeed in those areas. And given that they start from scratch. But in order to attract very skillful, creative, high talented employees, they have to pay an attractive compensation. But they have to compete with established companies, and established companies are usually much stronger financially, so they can afford, if they want to compete for those people, they can afford to offer higher salaries or higher wages. So what startup companies may say to you if they want you to come on board, we can't compete with an offer you can get from a big established company in terms of a compensation usual monetary compensation package, but we will make up for it, or we'll try to make up for it, by offering you a significant number of shares in the company. Now, the shares may be worth very little now because we're just beginning, but if we succeed, the sky is the limit. And then, if you are more of a risk taker, and you are also attracted by the challenge, the professional challenge of a startup, you may want to take them up for it. Now, many startups fail. So you end up working for a startup for several years for lower salary than you could have. And then they go out of business, and then the shares that you receive are worth nothing. So that's the risk. But the reward is that if you are savvy enough or lucky enough to choose a startup like Microsoft or Apple or Google or any number of those examples, then really the sky is the limit. You could, if you started with those companies and got a significant number of shares at the beginning, you could be by now independently wealthy and decide that you don't need even to seek employment for the rest of your life if you don't. So you can consume 24 hours of leisure if that's what you want. So that's the idea of compensation by equity. Now, another path, since many of you are going to be in public accounting, another path in public accounting firms are partnerships. They're not corporations. But if you decide that you want to make a career there and it works out and you like the firm and they like you and you succeed, you could get to the point where they offer you to become a partner. And of course, when you become a partner, part of your compensation as a partner is that you get a share in the ownership. And if the value of the firm goes up, you're compensated by a higher value of ownership. Okay, so that's equity compensation. Then we have another, which is contingent on the value of the ownership, in case of the corporation, the value of the shares. In case of partnership, the way you can realize the value of the ownership is if you are bought out. You're bought out by another partner. You reduce it, or when you leave or retire, your share is bought out. If it appreciated, then you are the beneficiary of the appreciation. Now then there are another very more prevalent even value contingent compensation instrument, and those are the ESOs. ESOs stand for employee stock options. So what is an employee stock? What are employee stock options? An employee stock option is the right. If you're an employee and you get stock option, and it's usually given at high levels, high echelons, in most cases. Some cases it's given to all employees a certain amount, but mostly it's given at high levels as an incentive. And in that case, and what an employee option in general is, employee stock option is the right to buy the shares of the company at a certain price over a certain period of time. So let's go over an example. Well, one thing to remember is that an employee stock option is somewhat different from a regular traded stock option in the sense that employee stock options are generally not traded on an exchange. They are granted to employees. And also they don't have a put component where you have shares that regular options which have a call and put component. Usually an employee stock option is of the call type, and it's not traded, so it doesn't have a market value. You can trade it in the market. You can decide whether you want to exercise it or not. So let's be more specific at what it's all about. Employee stock option. Let's assume that your company gives you the right to purchase shares, the shares of the company that you're employed at, for $56 within an exercise price. So let's be more specific. Let's assume that you're very highly valued in your position, your high executive position, and as a result, your company grants you 100,000 options, and the options are granted, just for the sake of the story, we have picked arbitrary dates, on December 2nd, 2012. Now, when the option is granted on December 2nd, the spot price of the share of the company, that is the market price, spot price is the market price at that time, is $52. Now, the strike price is known as the price at which the company is required to sell you the shares within a certain time period, which is called the exercise period. So in this case, the exercise period in this example starts on December 8th, 2014, and goes to December 20th, 2022. So there is about an eight-year window. Within this 8-year window, you're allowed to exercise the option, which means you as an employee can tell the company within that period of time that you want them to